I want to bring in Mona Mahajan, who is the head of investment strategy at Edward Jones. And Mona, you're not expecting a recession. So has the market overplayed to the downside this week?
Yeah, thanks, Becky. Look, we do think there is certainly an economic softening underway. We've seen that in the data. It's not uncommon in the first quarter, but what is unique is that we have this additional uncertainty and overhang from tariffs and government policy. So not surprised to see markets reacting how they are. Investors are actually understandably nervous here. What we don't yet see, though, is a recession on the horizon, to your point. And that's for a couple of reasons. One, we started from a position of relative strength. The economy in the fourth quarter was actually closer to 2.5% to 3% economic growth. And two, keep in mind, the U.S. economy broadly is relatively insulated from a trade perspective. Only 25% of a trade as a percent of GDP is about 25% versus 65% for Canada, 75% for Mexico. So a couple of factors why we don't see a recession on the horizon. We do think, though, this means there could be a pullback, but probably not a deep or prolonged bear market here.
Mona, the idea that we came into this year at really high multiples, though, 22 times earnings, was this something that was due, this correction? It happens every once in a while, and it hasn't happened for a long time.
Yeah, it's a fair point. Look, the last time we had a 10% plus correction was October 2023. And to your point, stocks have been pretty extended. We had two back-to-back 20% plus gains in the S&P 500. Valuations were also stretched, but probably most so in those mega cap tech, high growth parts of the market. And those are where we're really seeing the rotation. What's notable, though, is that there are parts of the market that have held up better. Value versus growth in the U.S. has held up better. Bonds have outperformed stocks, and international markets have done well as well. So that case for diversification certainly has made itself well known here in 2025.
So, Mona, what would you tell people to do at this point? Are there areas, pockets that you look and think, OK, the pullback has been too steep? Because even though it's only 10% for the S&P, there are plenty of stocks, if you look at technology in particular, or some of the consumer names where you've seen some pretty significant pullbacks, in some cases 20, 30% or more.
Yeah, you know, what we'd say is, one, we don't yet see this pullback, as we noted, becoming a deeper, prolonged bear market because we don't see a recession. We don't see Fed rate hikes. That's typically a requisite as well for bear markets. And so in that scenario, what we say is these pullbacks can be used as an opportunity. We do think in the U.S. we'd still look towards sectors like healthcare and financials. We'd make sure that we have some bonds to diversify the portfolio. Investment grade bonds, especially in that 7 to 10 year maturity space, continue to remain attractive for us. And when you look at your portfolio and you don't have any exposure, minimal exposure to international equities, this is a year we really think you could look towards non-U.S. as a diversifier here. So some opportunities to make sure that you maybe aren't participating as much during these U.S. stock market pullbacks this year.